Good morning, options traders, and happy Friday, everyone. Well, we're right in the beginning of another earnings season, and it should be no surprise with the coronavirus pandemic that we are seeing a lot of surprises to the upside and a lot to the downside. And so we're also starting to see, probably a lot more than usual, articles talking about using straddles and strangles to find the expected stock's move. And it's a topic that always confuses traders, because it's never quite explained how to use it. And so in fact, one of the traders in the group sent this article talking about this very thing. Netflix stock options traders are ready for a big move after earnings. And it says right here, straddles imply the stock could either soar or tumble by almost 13% on Friday. So how are they coming up with this number of 13% by using straddles? And unfortunately, this is about all the articles ever tell you, and so people come up with a lot of different myths and misperceptions. So for instance, in this very article, it says one way to gauge expectations on how much a stock is expected to move in reaction to earnings is through an option strategy known as a straddle. And then it just goes on to define what a straddle is. It never tells you how to calculate it, or more importantly, how to interpret it. And traders say, oh, I get it. You just look at the price of the straddle, and that's where the market thinks that the stock could move up or down. And that is absolutely not true. It can't possibly be true. Why is that? Well, let's take a look at a straddle. Let's say that this stock is currently at 100 and you buy the $100 call for 5 and the $100 put for 5. Now, yeah, technically in the real world, the 100 call is going to trade for a little bit higher price. But just to make it easy, they're both trading for 5, and we would say the 100 straddle is therefore trading for 10. So again, when traders see articles like this, they say, oh, I get it. We're just saying that the stock could move plus or minus 10, and therefore somewhere between 90 and 110. Well, that can't be true. Why? Because it also happens to be the break even on the 100 straddle. See, if you pay $10 for the 100 straddle, you need the stock to move 10 points up or 10 points down to recoup the cost of that straddle. So here's your profit and loss diagram. Here's 100, that's the maximum loss. Look at the upper break-even point, right here at 110. That's where it crosses this horizontal zero line. So if the stock goes to 110 at expiration, you just break even. If the stock falls to 90, right here, another crossing point, you just break even. So think about it. Would you buy the 100 straddle for 10 if the market truly thought the absolute range for the stock was somewhere between 90 and 110? That's just saying the very best you could do is break even, and other than that, you're going to lose. So that tells us that the price of the straddle would have to fall, or the interpretation's wrong. There has to be bigger moves beyond the price of the straddle. So what are we talking about when we say an expected move? Well, when professional traders talk about an expected move, it is a 1 standard deviation move. And under a bell curve, that is about 68% chance for that to happen. So many of you who have had statistics will recognize our bell curve down here. In this blue area right here in the center is a 1 standard deviation move. And again, about 68% of your observations will fall right in that middle portion. But if we go out 2 standard deviations, we're looking at the gray plus blue. And that's 95% of the area, or a 95% chance for that to happen. And then finally, if we go out to 3 standard deviations, including these red tails, that's essentially all of the data, technically about 99.7%. So the first important thing to understand that when we're talking about expected moves, it is just a 1 standard deviation move. So to put it into a simple example, let's say that you flip a coin 100 times. What's the average number of heads you should expect? Well, it would be 50. So you can think of that as the current stock price. And if we worked out the standard deviation, it would turn out to be 5. So a 1 standard deviation move is plus and minus 5. So we would say, yes, my best guess is that we're going to see 50 heads, but somewhere around 45 to 55 would be my expected move, or my expected guess, at least to put it in stock market trading terms. So we would say somewhere between 45 and 55. But now it should shed some light on the problem. Does this mean we can't see 56? Not at all. Could easily happen. In fact, 2 standard deviations would be 60. That wouldn't be all that uncommon. 2 standard deviations down would be 40. So just because somebody might write, this is the expected range, does not in any way mean that this is what you're going to see virtually every time. So how do we calculate this? Well, there's a number of formulas, and just for the record, I want to put the accurate one up on the video, but then I'm going to show you some easy ones in just a moment. So if you want to know the real true formula for finding the expected move, you're going to take the stock price, you're going to multiply it, and you're just going to look on your calculator for this little button called E, and we're going to raise that to the volatility times the square root of time. So let's say that the volatility on your broker's platform is 20%. And let's just say we're looking at a 1-year time frame. That way the calculation's easy. Square root of 1 is 1. What's the expected move? Well, if the stock is 100, we multiply it by E raised to the 0.20, that's the volatility, times 1. And that's going to come up to 122. So I've simplified the formula a little bit. That's just showing the upper range would be 122. So by symmetry, we would say it could also fall 22 or down to 78. So in stock market trading terms, we would say the expected move over the course of a year is 78 to 122. All right, this is what we would technically do even if it's over the course of a week or whatever the case happens to be for earnings. That's really what we'd like to do. Now, of course, most people aren't going to go through that, so they try to resort to some easier methods, which are still really accurate because we're usually only talking about a week till expiration. So what are the 2 easy methods? Well, you can use just straddles, or you can use straddles and strangles. So let's take a look at the first method. It's super easy. Take your at-the-money straddle and multiply by 0.85. So if the stock is 100, we look at our 100 straddle again, and let's say that it's trading for 10. Take 10 times 0.85, we would say the expected move is about $8.50. So you're going to look at $8.50 up and $8.50 down. But that does not mean that's the absolute limit. That's just a 1 standard deviation move. So where's this 85% number coming from? Well, if we look at all of the area in our bell curve here from the left up to 1 standard deviation up, that's about 85% of the area. So we're just saying we're allowing for it to go beyond 1 standard deviation, but we want to account for all of the area below that. So that's going to give you a reasonably good estimate. What else can you do? Well, the second method is to use the straddle and the strangle. And here's what you're going to do. You're going to take the straddle plus the strangle prices and divide by 2. So if our stock is 100, the 100 straddle, that's the at-the-money straddle, let's say again is trading for 10. What you want to do next is look at 1 strike out of the money for your strangle. So that would be the 95-105 strangle. For those of you who might not know what a strangle is, it's similar to a straddle, but we're going to look at the 95 put. That's 1 strike down, and we're going to look at the 105 call. That's 1 strike up. So let's say that they're both trading for about 3. We add those together, that's 6. So we would say the 95-105 strangle is trading for 6. So what does our formula tell us here? Take the 100 straddle plus the strangle, add them together, we get 16, we divide by 2, and we get 8. Pretty close to what we came up with the previous method. So either of those formulas will certainly give you a reasonably good estimate of what an expected move is. The most important thing to understand is that whatever that limit is, it is not some type of a fence where the stock price just cannot get out of. It is simply a 1 standard deviation move, and we could easily see prices much higher or lower. So I hope that helps you to make some sense of whenever you see these articles coming out talking about expected moves. For those who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.